For a lot of people, there comes a point when they kind of realize, all right, I really need to figure out this whole stock market thing. It's time to start building some real wealth, not just let my money sit there. And that's exactly what we're diving into today.
Couldn't agree more. It's a common turning point, that realization that you can be more proactive with your money.
So we've got a fantastic guide to help us navigate this journey. Investing Habits, a beginner's guide to growing stock market wealth by Steve and Holly Burns.
A really practical, down-to-earth book.
Definitely. And our goal today is to pull out those key actionable principles that anyone, regardless of their financial starting point, can use to start building a solid investment portfolio.
Absolutely. Think of this as your shortcut to the essentials, getting you past that initial hurdle and into action.
So first things first, right? What actually is the stock market? I mean, we hear the term all the time, but breaking it down.
Yeah, demystifying it a bit.
Exactly. At its core, it's basically a marketplace where you can buy and sell pieces of publicly traded companies. You're essentially becoming a part owner.
Right. And when these companies need to raise money, they sometimes offer shares of their stock to the public for the first time through what's called an IPO, an initial public offering.
Like going public, right?
Exactly. And after that IPO, those shares start trading on the open market, and their price is constantly fluctuating based on, well, good old supply and demand, what investors are willing to pay at any given moment.
So how does that actually work, that price going up and down?
It's all driven by something called bids and asks. A bid is the highest price someone's currently willing to pay for a share, and an ask is the lowest price a seller is willing to accept. And every time a buyer and seller agree on a price and make a trade, boom, that becomes the new market price.
Interesting. So it's like a constant auction happening.
In a way, yes. And one important metric to understand when looking at a company on the stock market is its market capitalization, often called market cap.
What does that tell us?
It's basically a measure of the company's overall size and value. It's calculated by simply multiplying the current stock price by the total number of outstanding shares.
So the higher the stock price and the more shares out there, the bigger the company's market cap.
Exactly. It gives you a sense of scale. Now, generally, the company itself isn't directly involved in this everyday buying and selling of its stock after that initial IPO, but there are some interesting exceptions.
Oh, like what?
Well, one is a stock buyback, where a company decides to repurchase some of its own shares from the open market.
Why would they do that?
Sometimes, management believes their stock is undervalued, basically, that the market isn't fully recognizing the company's true worth. By buying back shares, they reduce the number of shares available to the public, which can sometimes give the stock price a little boost.
So it's like they're putting their money where their mouth is.
You could say that. Another way a company can directly interact with its shareholders is through dividends.
Dividends, right. Those are those payments you get just for owning the stock.
Exactly. They're typically paid out quarterly, and they represent a portion of the company's profits that's distributed directly to the shareholders.
So as a shareholder, you're getting a piece of the pie.
Exactly. You could even calculate a dividend yield, which essentially tells you the annual return you'd get just from the dividends, by dividing the total annual dividend payments per share by the current stock price.
Okay, that's useful to know. But what about those times when a company wants to raise more money?
Right. They might conduct what's called a secondary offering, which is basically issuing new shares after that initial IPO.
But doesn't that kind of dilute the value of the existing shares?
It can, and that's why secondary offerings are often viewed a bit more cautiously by the market. They're not always a negative signal, but it's something to consider.
So with all this activity happening, buybacks, dividends, offerings, and the constant price fluctuations, the stock market can be quite dynamic, wouldn't you say?
Oh, absolutely. It's a real roller coaster at times. But as the book emphasizes, that dynamism is precisely what makes it such a powerful tool for both building wealth and potentially losing it.
It's that double-edged sword, isn't it? The potential for big gains, but also the possibility of significant losses.
Right. And it's important to understand that the market moves in cycles. You've got those long-term trends, what are called secular bull markets, where the overall market is generally going up over a period of years, and secular bear markets, where the trend is downwards.
Like those long waves we see in history.
Precisely. And then you've got those shorter-term fluctuations, the bubbles, those periods of, let's say, irrational exuberance, corrections, a 10% dip from a recent high, bear markets, a more significant 20% drop, and even crashes, those dramatic plunges of 50% or more.
The ones that make headlines.
Exactly. And if we connect this to the bigger picture for you as an individual investor, It's crucial to realize that the stock market isn't some guaranteed get-rich-quick scheme. It's not a casino.
It's not just about picking the next hot stock and hoping for the best.
Right. It's more accurately described as a game of long-term survival, strategic decision-making, and disciplined participation in economic growth.
It's about understanding that some companies will flourish, their stock prices soaring, while others might stumble or even completely fail, potentially leading to losses for investors.
And sometimes even delisting from the exchanges altogether if the company goes under. It's a true reflection of the dynamism and, yes, sometimes a ruthlessness of free market capitalism.
So, where do we fit into all of this? What's our role as investors in this whole ecosystem?
Well, according to Investing Habits, success in the stock market boils down to two core abilities: consistently allocating your money to promising opportunities.
So it's not just about riding the general market upward trend, it's about picking the right companies.
Exactly. Identifying and investing in individual companies that are showing genuine growth in their sales and earnings. That's what typically drives a stock price higher over the long run. And the second key ability,
Is it knowing when to sell?
that's a big part of it, absolutely. Knowing when to take profits off the table. And just as importantly, minimizing losses when the market takes a downturn or a particular company's prospects start to look shaky.
So it's not just about when to get in, but also when to get out.
Exactly. There's a time to be actively invested and a time to exercise caution, maybe even move to the sidelines for a bit.
I like that. Knowing when to hold them and knowing when to fold them, right? But one of the things the book really emphasizes right at the beginning is the importance of just getting started, taking action.
And, they stress that for most people, the biggest obstacle isn't necessarily a lack of knowledge or understanding, but just that inertia, that failure to take those first steps.
It's like anything else in life, isn't it? Wanting to get in shape, wanting to learn a new skill. You can read all the books and watch all the videos, but until you actually start doing something, you're not going to make any real progress.
Absolutely. And what's fascinating is that parallel with something like wanting to lose weight, we often already know what we need to do, right?
Yeah.
Eat healthier, exercise more, just like we generally understand that we should be investing for our future.
But knowing and doing are two very different things.
Exactly. And that's why the book highlights this as investing habit #1. Take action today when you know what to do. Don't let that knowledge just sit there in your head. Put it into practice.
Makes you think, doesn't it? Are there any investment-related tasks that you've been putting off? Maybe opening a specific account, setting up an automatic transfer?
Even those seemingly small steps can be huge in building positive financial habits.
Right. It's about paving the way for long-term success. Now, another interesting perspective the book encourages is to kind of rethink how we traditionally view making and accumulating money,
It challenges that typical employee-consumer mindset.
where we trade our time and skills for a paycheck, and then a lot of that paycheck goes towards buying things that actually lose value over time: cars, clothes, gadgets.
That depreciation cycle.
But investing, as the book points out, offers a different path. It allows you to become an owner, a shareholder in companies, with the potential to benefit directly from their growth and profitability.
And not just through an increase in the stock price, but also potentially through those dividend payments we talked about earlier.
So as an investor, you're not just a consumer spending money, you're participating in wealth creation.
Exactly. And over time, investors accumulate assets that ideally appreciate significantly in value. Think of iconic companies like Apple or Microsoft. Their stock values have skyrocketed over the years as they've expanded their customer base, increased sales, and generated more profit.
And those are just two examples. There are many others out there.
Right. And what's insightful for you as a potential investor is where those investment ideas can come from. The book suggests looking closely at your own everyday experiences as a consumer. What products or services do you find truly valuable? What companies do you regularly do business with and have a positive impression of?
So basically, the things you're already spending your money on.
Exactly. If a company is consistently delivering a great product or service that people love and are willing to pay for, leading to growth and expansion, well, that could be a company worth considering as an investment.
Makes sense. But how do you actually evaluate a company as a potential investment? I mean, where do you even begin?
The book lays out some key areas to focus on. On one side, you've got the company's fundamentals, things like its revenue, its profit margins, which tell you how much profit it makes for every dollar of sales, its competitive advantages, what sets it apart from its rivals, the overall industry it operates in, and its potential for future growth.
So it's about understanding the underlying strength of the business itself.
Right. But then you also need to consider the technical aspects, which involve looking at the stock's price action. Is the current price a good entry point? Is the stock potentially undervalued compared to its intrinsic worth, or maybe overvalued, with a lot of future growth already baked into the price?
So it's not just about the business, it's about how the market is valuing that business.
Exactly. And you also want to look at the stock charts. See what they reveal about its trend. Is it generally moving upwards or downwards? And is there a reasonable safety margin if you buy at this price? Meaning, is there room for the stock to potentially go down a bit without wiping out your investment?
So it's a dual analysis, the business itself and how the market is currently perceiving that business. Now, the book also places a lot of emphasis on a really fundamental habit, paying yourself first.
And this is such a crucial concept for shifting your mindset around money. It's not about investing whatever's left over at the end of the month after you've paid all your bills.
It's about making investing a non-negotiable part of your financial plan.
Exactly. Treat it like a regular bill that you pay to yourself, right up there with your rent or mortgage, utilities, groceries.
Even if it's a small amount at first.
Exactly. Even small amounts, consistently invested over time, can grow significantly due to the power of compounding, which we'll talk about more in a bit. But the key takeaway here is to make investing a priority, not an afterthought.
And when it comes to actually investing that money, the book recommends exploring different types of accounts depending on your financial goals and how long you plan to invest.
Right. For shorter-term investing or more active trading, a standard brokerage account might be suitable. But for longer-term goals, particularly retirement, those tax-advantaged accounts, like a traditional or Roth IRA, a 401k, or a 403b, offer some significant benefits.
Especially those tax-deferred accounts, right?
Yes. The traditional IRA and 401k in particular, those often allow you to contribute pre-tax dollars, and your investments can grow without being taxed until you withdraw them in retirement.
So your money is working harder for you because you're not losing a chunk of it to taxes every year.
Precisely. And if we connect this back to you taking action, the book highlights investing habit, #2. Create and follow a consistent investment plan aligned with your goals and time frame.
So before you even start picking investments, it's about having a plan.
Right. Ask yourself, what are your financial goals? Are you primarily investing for retirement, or do you have some shorter-term objectives? What type of account aligns best with those goals? And how much can you realistically commit to investing on a regular basis?
And automation is key, right? Setting up those automatic transfers so you don't even have to think about it.
Absolutely. Make it effortless.
Yeah.
Now, here's a really interesting angle that the book brings up. Your potential role as an investor if you happen to work for a publicly traded company.
So investing in your own company.
Exactly. And as long as you're acting on publicly available information, it's perfectly legal.
So you're not using any insider information or anything like that.
Right. It has to be information that any investor could access. But what's fascinating is that this can create a really interesting alignment of interests.
How so?
Well, publicly traded companies are always striving to improve their financial performance, boost their stock price, and guess who benefits directly from a rising stock price?
The executives with their stock options and all that.
Exactly. So as an employee, you're contributing to the company's success through your hard work. And then as an investor in that same company, you stand to gain financially from that success.
So it's like a double win.
Precisely. And many companies even offer employee stock purchase programs where you can buy company stock, often at a discount or without any brokerage fees, right through payroll deductions or even within your 401k.
So it's like a built-in advantage.
It can be. But the book does offer some important caveats. This strategy tends to work best if you're working for a company that's truly innovative, operating in a strong, growing industry. And critically, if the company's stock price is already on an upward trajectory, ideally trading near its 52-week high or even its all-time high.
So you want to be riding that wave of momentum.
Exactly. This leans towards what's called growth investing, focusing on companies with robust earnings and revenue growth, which can often lead to faster returns compared to value investing, which seeks out companies that are perceived as being undervalued by the market.
And it's probably wise to stick with companies that are listed on those major stock exchanges, right? The NYSE, the NASDAQ.
Generally, yes. You want to avoid venturing into those riskier over-the-counter markets, or what are called pink sheets, where there's less regulatory oversight and potentially more volatility. Now, some financial advisors might caution against investing too heavily in your own company simply for diversification purposes.
Don't put all your eggs in one basket.
Exactly. But the book does point to some pretty compelling success stories, like Bill Gates with Microsoft, Warren Buffett with Berkshire Hathaway, where significant wealth was created through concentrated investments in the companies they led.
So it can work, but you have to be smart about it.
Right. The key takeaway is that the company needs to be a genuine winner, exhibiting strong growth, innovation, efficiency, a powerful brand, and a healthy rising stock price. And the book even suggests a potential warning sign. If your company's stock price drops below its 200-day simple moving average, that's basically the average of its closing prices over the past 200 trading days, it might be a good time to reevaluate your investment.
A signal to potentially take a closer look.
Exactly. It all comes down to assessing both the company's fundamental strength and the trend of its stock price. And this leads to investing habits. #3. If you work for a great growing company, consider becoming an investor. Look for robust earnings and sales growth, those sustainable competitive advantages, and a leadership position within its industry. But stay vigilant if the stock price dips below that 200-day moving average. It might be a sign that the momentum is shifting.
Now let's talk about something that none of us can avoid, taxes. But investing habits actually dives into how we can use the tax code to our advantage when it comes to investing.
It's about understanding the rules of the game and playing strategically.
Exactly. And one of the most powerful concepts the book emphasizes is the idea of paying yourself before taxes by making contributions to those tax-advantaged retirement accounts.
Your traditional IRAs, 401ks, 403bs, or 457b plans, these are powerful tools.
And even though the specific contribution limits mentioned in the book might have changed since it was published in 2016, the underlying principle is still incredibly valuable.
Absolutely. The beauty of these accounts is threefold. First, you reduce your taxable income in the present. That means you're paying less in income taxes this year. Second, any investment gains you make within these accounts aren't taxed until you withdraw them in retirement.
So your money is growing tax-deferred, compounding year after year without the IRS taking a cut along the way.
Exactly. And third, there's the general expectation that you might be in a lower tax bracket in retirement when you do start taking those distributions. So you could end up paying less in taxes overall.
It's like a triple win.
Right. Now, the book does compare these traditional tax-deferred accounts with Roth accounts,
where you pay taxes on your contributions up front, but then qualified withdrawals in retirement are tax-free.
Right. And the authors generally suggest that for most people, especially those earlier in their careers, or who expect their tax bracket to be lower in retirement, the immediate tax benefits of those contributions, traditional tax-deferred accounts, make them the more advantageous choice.
You're essentially getting a tax break now, which can make a big difference in how much your money can grow over time.
Absolutely. And the book even reframes the typical income process for you. Instead of that traditional sequence of earn income, pay taxes, get paycheck.
It becomes earn income, invest in tax-deferred accounts, then taxes are calculated, resulting in your paycheck.
Right. By shifting that order, by putting investing before taxes, you're essentially maximizing the amount of money that's working for you from the start. And what's important to understand is that the government has created these tax advantages to incentivize people to save for retirement, especially with the decline of those traditional employer-funded pension plans and the concerns about the long-term stability of Social Security.
It's like a built-in benefit, but you have to take advantage of it.
Exactly. And that's why the book highlights this as investing habit, #4. Contribute to a tax-deferred retirement plan to lower your current taxes and allow your money to grow tax-free.
Now let's move on to what the book aptly calls the eighth wonder of the world, the power of compounding returns. I remember when I first truly grasped this concept, it was like a light bulb moment.
It's one of those financial concepts that can seem almost magical.
It really is. It's the idea that money, over time, can essentially generate its own additional money, growing exponentially.
Exactly. And the book's author even shares a personal anecdote about learning about compound interest at the age of 16 and being completely blown away by how a relatively small amount of money could potentially double and redouble over time with consistent returns.
So it's not just about earning interest on your initial investment, it's about earning interest on the interest itself.
Exactly. It creates this snowball effect. For example, with a hypothetical 12% annual return, if you invested $10,000, it would roughly double to $20,000 in about 6 years.
Okay, that makes sense. But what happens next is where it gets really interesting.
Right. In those next 6 years, it wouldn't just grow by another $10,000. It would double again to $40,000 because you're now earning returns on $20,000, not just the original $10,000.
So the growth accelerates.
Precisely. And while consistently achieving a 12% annual return might be a bit ambitious, the book does point out that historically, the S&P 500 index has delivered average annual returns of around 9.7%, and small-cap stocks even higher, around 12.7% over long periods.
So the potential is there.
Absolutely. But the key is to focus on consistent growth and, just as importantly, avoiding those big losses that can really set you back.
Because it's not just about how much you gain, it's also about how much you avoid losing.
Right. And what's crucial to understand is that math of loss and gain. If you experience a 10% loss on your investments, you'll need an 11% gain just to get back to where you started.
So losses hit you harder than gains help you.
Exactly. And a more significant loss, like 50%, would require a whopping 100% gain to break even. That's why it's so important to be mindful of risk, especially when you're just starting out.
And probably avoid those more speculative, high-risk investments, right?
The book specifically advises against dabbling in complex financial instruments, like options or futures, unless you really understand how they work and the risks involved. For most beginners, those are more like gambling than investing.
Aim for those steady long-term gains through participating in market uptrends and have a plan for protecting your capital when things inevitably get a bit rough.
Exactly. And this brings us to another cautionary tale from the book about a friend who cashed out his retirement account early and the huge opportunity cost he paid by missing out on decades of potential compound growth.
A real-life example of the dangers of short-term thinking.
Exactly. And that story really drives home investing habit. #5. Don't touch the money that's earmarked for long-term compounded returns.
Resist that urge to dip into your retirement savings for short-term needs.
Right. Have a separate emergency fund for those unexpected expenses, and make sure you have adequate insurance coverage to protect your investments from life's curveballs.
And while starting to invest early in life gives you the longest runway for compounding, it's never too late to begin.
The book notes that once you hit that six-figure mark with your portfolio, the growth really starts to accelerate. It's like that snowball getting bigger and rolling faster downhill.
And it's important to remember that compounding works both ways. Just like your investments can grow exponentially over time, so can debt.
Those high-interest credit card balances, even mortgage interest, can compound against you if you're not careful.
So the same principle that can build wealth can also erode it.
Exactly. And the book even mentions a useful rule of thumb called the Rule of 72, which helps you estimate how long it will take for an investment to double at a given interest rate.
How does that work?
You simply divide 72 by the annual interest rate. So if you're earning a hypothetical 6% return, it would take roughly 12 years for your investment to double.
Okay, that's a handy little trick. But, the biggest challenge with compounding isn't the math, it's the behavior, right?
Absolutely. It's about resisting that urge to withdraw funds, to stay patient, and let that money work its magic over time. That's where having a solid financial plan and a clear understanding of your long-term goals comes into play.
It's about delaying gratification for a much bigger payoff down the road.
Precisely. Now let's shift gears and talk about something the book calls the 100% return that most people miss. And it's not some complicated trading strategy or secret loophole.
It's actually something surprisingly accessible to a lot of people.
It all comes down to a piece of advice from financial guru Dave Ramsey about employer matching contributions to retirement plans.
Like those 401k matching programs.
Exactly. And while day traders might brag about their big wins, and even the most successful money managers average maybe around 20% returns annually, the authors point out that a huge number of employees have access to an instant, guaranteed 100% return just by fully participating in their company's matching program.
It's free money, essentially.
It really is. And it's amazing how many people are either completely unaware of this benefit or just don't contribute enough to take full advantage of it. The book explains that these matching programs have largely replaced those old-fashioned pension plans.
Which were kind of like a guaranteed income for life after retirement.
Right. But those became too expensive for many companies to maintain. So they shifted to these defined contribution plans like the 401k, where the employee shares the responsibility of saving for retirement.
And to incentivize employees to contribute, they offer these matching programs.
Exactly. The typical setup is that for every dollar you contribute to your 401k, up to a certain percentage of your salary, your employer matches it with a dollar of their own.
So if you put in $1, they put in $1.
It's an instant doubling of your money. And the book gives a clear example. If you earn $50,000 a year and your company offers a 5% match, and you contribute 5% of your salary, which is $2,500, your company kicks in another $2,500. That's a risk-free 100% return on your investment.
And it's all pre-tax money, too.
Right. So you're getting a tax break on top of the matching funds and the subsequent tax-deferred growth. Now, some companies even match your contributions with shares of their own company stock.
So you're essentially buying that stock at half price.
Exactly. And if the company's stock does well, your returns can be even more impressive. But there's often a catch: vesting periods.
Meaning you can't just turn around and sell those shares immediately?
Right. There might be a certain period of time you have to work for the company before you fully own those shares and can sell them without penalty.
So it's something to be aware of.
Definitely. The book suggests that once you are eligible to sell those shares, it might be a good risk management strategy to diversify, unless you're working for a truly exceptional company with a very strong track record of growth. And even then, having a long-term exit plan is probably wise.
Don't get too attached to any one investment.
Right. Diversification is key for managing risk. But the fundamental habit for you to adopt is investing habit, #6. Find out exactly what your employer's matching contribution is and make absolutely sure you're contributing enough to get the full match.
It's free money you don't want to leave on the table.
Absolutely. The book even points out the opportunity cost of not contributing enough. For example, let's say you're financing a new car, and that monthly payment prevents you from contributing enough to get your full employer match.
So you're essentially doubling the cost of that car over the long run.
Precisely. It's a hidden cost that many people don't even realize. Now let's shift gears and talk about where to actually invest your money. The book makes a strong argument for why investing in the S&P 500 index can often be a better strategy than trying to pick individual stocks or investing in actively managed mutual funds.
So instead of trying to beat the market, you're aiming to match the market's performance.
Exactly. And it turns out that's not as easy as it sounds. The book even cites a statistic from the New York Times highlighting a period where not a single U.S. stock mutual fund managed to outperform the overall market.
So those professional stock pickers couldn't even beat a simple index fund.
That's right. And over the long term, the book states that roughly 80% of actively managed mutual funds underperform their relevant benchmarks.
That's a pretty dismal track record.
It is. And one of the key reasons a simple, low-cost S&P 500 tracking ETF, like SPY, consistently outperforms those actively managed funds is its low expense ratio.
So you're not losing a big chunk of your returns to management fees.
Exactly. But it's not just about fees. It's also about following a transparent, rule-based system.
The S&P 500 itself.
Right. The index is managed mechanically, based on the market capitalization of the 500 largest publicly traded U.S. companies. There's no fund manager making subjective decisions, trying to predict which stocks will do better than others.
So it takes the human element out of the equation.
To a large extent, yes. And the third key advantage. By definition, an S&P 500 index fund is the market. So it can't underperform the market as a whole.
Makes sense. You're essentially buying a tiny piece of the entire U.S. stock market.
Exactly. And those actively managed funds are constantly fighting an uphill battle because of those inherent fees and expenses.
Plus, they're paying their managers regardless of whether they beat the market or not.
It's a tough business. Now, it's important to understand that market indexes like the S&P 500 aren't static. They evolve over time.
Companies get added, companies get removed.
Right. And that's actually a good thing. It's a form of survivor bias. The companies that perform well and grow in market cap tend to stay in the index, while those that decline or become less relevant are eventually removed.
So it's a dynamic system that reflects the overall health and growth of the market.
Precisely. And unlike individual fund managers who might be susceptible to those short-term performance pressures or even personal biases, the committees that oversee these indexes tend to follow more objective, rule-based criteria. The S&P 500, for example, is managed by a committee at S&P Global, a financial data and analytics company.
So it's not about trying to outsmart the market. It's about aligning yourself with the market's overall trajectory.
Exactly. And indexes also evolve to reflect those broader changes in the economy and the technological landscape. The book even provides a fascinating illustration of this by listing the original 12 components of the Dow Jones Industrial Average from when it was first created in 1896.
Which was heavily tilted towards those industrial giants at the time, right?
Right. And it contrasts that with the 30 components as of 2016, showing the dramatic shift towards those technology and consumer-focused companies that dominate the market today.
It's a reminder that the market is constantly adapting and evolving.
Exactly. So for you, the simplest and often most effective way to invest in a broad market index is through those low-cost ETFs. You've got SPY for the S&P 500, DIA for the Dow Jones Industrial Average, QQQ for the NASDAQ 100, and IWM for the Russell 2000, which focuses on small-cap companies.
And those ETFs can be traded throughout the day, just like individual stocks.
Right, and they typically have very low expense ratios. Now, your 401k plan might primarily offer index mutual funds rather than ETFs, but those still provide similar benefits. Just make sure to look for the word index in the fund name and check the prospectus to see which index it's tracking and what the fees are.
So if you see index and low fee, you're probably on the right track.
Exactly. Now, the book also has some strong opinions on mutual funds to avoid. Steer clear of those that charge load fees.
Which are essentially sales commissions, right?
Right. Either paid up front when you buy the fund or when you sell it. And watch out for redemption fees, too. In today's world, with so many no-load mutual funds and those low-cost ETFs available, there's really no reason to pay extra just to buy into a mutual fund.
So do your research and make sure you're not getting hit with unnecessary fees.
Exactly. This all leads to investing habit #7. Stop investing in those actively managed mutual funds and allocate your money to low-cost index mutual funds or ETFs instead.